Well, it is going to be crushing. He sparked a trade war. I talked to farmers who are still digging out from the tragedy that was, and now they're looking at it again.
Right. Are you angry?
It's difficult to be angry on somebody else's behalf.
So it's not about you, it's not about your farm and the fact that you bought a farm to avoid inheritance tax.
But as we think about the farmers and the headwinds that they face, I can think of a number of them. Fertilizer costs, fuel costs, labor shortages.
$27 billion is the value of U.S. agricultural exports to China in 2024. But in just 1 week, soybean exports dropped 50% and pork fell 72%. Why is this largest market pulling back? What consequences will American farmers face? The hardship of American farmers and China's strategic shift. In 2024, China imported $27 billion worth of U.S. agricultural products, making up the majority of the country's total agricultural exports. However, as tariffs increased sharply, everything changed rapidly. Within a single week, soybean exports to China fell by 50% and pork by 72%. This is not just a number. It represents a real crisis for American farmers. Inventories piled up unsold, prices plummeted, forcing many to suffer heavy losses and even face bankruptcy risks. Why did China withdraw? They quickly shifted to other partners. Brazil became the new largest soybean supplier, with forecasts of over 31 million tons imported just in the second quarter of 2025. China also invested heavily in Brazil's port infrastructure and signed long-term contracts with Argentina and several other South American countries. This is not a temporary reaction, but a long-term strategy to reduce dependence on U.S. agricultural products. Impact in the U.S. and political reactions. The direct consequence of losing the Chinese market is massive economic damage on U.S. soil. In states like Iowa, farmers reported losses of more than $25 per acre. Total damages run into millions of dollars regionally, severely affecting the livelihoods of thousands of families. Not only farmers, but related industries, such as agricultural equipment, feed stores, and machinery repair services, are also seriously impacted. Many small businesses are forced to scale down and workers are laid off. Politically, pressure from this crisis is causing lawmakers to consider proposals to limit the president's unilateral tariff powers. The goal is to avoid uncontrolled market fluctuations that severely harm agriculture. Widespread discontent among farming communities is strongly shifting voting trends in traditional agricultural states, opening new political developments, new development strategies, and the future of American agriculture. Facing major disruptions from the Chinese market, American farmers and policymakers are beginning to explore new directions to reduce this dangerous dependency. One key strategy is diversifying export markets. Southeast Asia, Africa, and Latin America are seen as rapidly expanding potential markets with growing demand for agricultural products. Developing these markets not only reduces risks, but also opens opportunities for sustainable growth of U.S. agriculture in the long term. Moreover, the agriculture sector is focusing on investing in value-added products and food processing. Instead of only exporting raw materials, developing processed products with higher economic value will increase profits and competitiveness globally. Technology also plays a critical role. Applying modern supply chain management technologies like blockchain helps ensure product origin and quality, while enhancing operational efficiency and transparency in international trade. The future of American agriculture requires a stable multilateral trade strategy that avoids volatile tariff policies. Innovation in technology and market diversification are the keys to maintaining competitiveness and sustainable development amid today's complex geopolitical environment.
Putting a 200% tariff on everything that you want to sell into the United States, so that if I win, John Deere is going to be paying a 200%. They haven't started it.
$400,000 for a single tractor. Yes, double the original price. And the reason? A tariff order from the White House. Before John Deere could even react, the market had already begun to shake. John Deere faces a 200% tariff. At a town hall in Pennsylvania, former President Donald Trump announced a 200% tariff on John Deere machinery imported from Mexico. That means a $200,000 tractor now costs $400,000, an increase that has dealers and farmers alike worried. John Deere responded immediately, stating it was conducting a comprehensive assessment of the new policy and potential countermeasures. Behind closed doors, engineers are crunching numbers because if they fail to adapt, who pays the price? Farmers, consumers, or the entire U.S. economy? What's more, the production lines in Mexico have been saving John Deere tens of millions of dollars each year. Relocating back to the U.S. would not only be costly, but also time-consuming. On top of that, nearly 40% of components in their best-selling models come from abroad, meaning the tariff doesn't just hit assembly lines, but could disrupt the entire supply chain. Impact on farmers and manufacturing. Immediately following the announcement, dealers reported a spike in orders within just a week. Farmers rushed to buy equipment before the tariff took effect. But behind the urgency lies a growing fear. If retroactive taxes are imposed, who will bear the massive cost difference? At agricultural fairs in Kansas and Iowa, the mood turned grim. "We're just watching. We haven't dared to sign anything," one farmer said. And the looming question, buy now to lock in prices, or wait and risk doubling your costs. John Deere's strategic response. Facing this sudden blow, John Deere didn't retreat. It shifted into strategic mode, launching 3 major moves nearly simultaneously. First, the company accelerated reinvestment into plants in Iowa and Illinois, facilities previously scaled back due to high operating costs. Now, despite expensive domestic labor, Deere sees this as the only way to reduce dependence on cross-border supply chains, now a liability under tariff threats. Resuming U.S. production is not only an economic decision, but also a symbolic gesture to regain domestic market trust. Second, Deere ramped up lobbying in Washington, seeking tariff exemptions for key agricultural components like drive systems and smart control units. If successful, the company could maintain stable pricing without sacrificing quality or profit. But this is a long game, requiring political leverage. Failure could send ripple effects across the agricultural machinery sector. Third, Deere began restructuring its supply chain, shifting some production to Canada or other low-tariff countries. This is a global flexibility gamble aimed at avoiding being boxed in by an escalating trade war. Policy impacts and global reverberations. The impact doesn't stop at Deere. Other manufacturers, from Caterpillar to GM, are watching cautiously. Economists warn that if trade tensions persist, next quarter's GDP could shrink. Countries like Canada and Mexico have already responded. The EU and Japan are preparing cases to challenge the US at the WTO. In strategy rooms, analysts are modeling what-if scenarios. If the 200% tariff holds, production costs will balloon. If reduced to 50% on imported parts, companies might catch a breath. As May 15th approaches, pressure builds by the hour. Businesses await rulings, investors sit on cash, and those behind the tractor wheel, the farmers, may cast decisive votes in the upcoming election. Meanwhile, China watches from the sidelines, but not passively. Manufacturers in Shanghai and Guangdong are already expanding their lines, ready to absorb production flows leaving Mexico. Some experts warn if the US overplays its internal tariffs, Beijing could be the biggest winner from this global repositioning. Will the administration ease off or tighten the screws? If this is a test of endurance, it's also a reminder, tariff decisions aren't just numbers. They shape the fate of entire industries. What if I told you that Christmas 2025 could be drastically different from what you expect? You know, the usual excitement with kids running to unwrap their new Barbie dolls and Legos? Brace yourself, because prices on toys could soar by 10 to 20%. And who's to blame for this holiday nightmare? When we talk about tariffs, we're talking about the taxes on goods coming into the country. Under President Trump, tariffs have been placed on many goods coming from China, including most toys. Experts predict that these tariffs could increase the price of toys by up to 20% this holiday season. For example, a $20 toy could now cost you $24. And while domestically produced goods may not be hit as hard, the majority of toys and consumer products are imported. This means that the average consumer will pay the price of Trump's trade war at the checkout. Families with lower and middle incomes will feel the pinch the most. Imagine this. You have less money to spend on your kids' presents, making it harder to stay within budget during the holidays. What's meant to be a season of joy, love, and gift-giving could feel like an unwanted financial burden. As prices rise, Consumers might look for cheaper alternatives, but it could mean families can't get the exact toys they wanted for their kids. This reduces the holiday magic that many families expect during Christmas time. The pressure builds up, creating financial stress, and we all know that stress isn't what the holidays are about, right? Let's talk about businesses for a minute. Especially the small businesses in the US toy stores and retailers are already facing higher prices due to these tariffs. Not to mention, supply chains are disrupted. This could result in product shortages, leaving store shelves bare just before Christmas. For example, a $50 toy could go up to $65, which isn't exactly great news for families who want to buy gifts, but also want to stay within budget. When small businesses can't offer affordable prices, it not only hurts their bottom line, but also affects the entire market. Big corporations may be able to handle the price hikes, but small retailers will bear the brunt of these changes, making it even harder for them to stay competitive. What's the bigger picture here? President Trump's tariffs are having more than just a ripple effect on toys. They are actually impacting the entire US economy. Experts are warning that the US GDP could shrink by up to 0.5% in 2025. That's a significant dip, and it's being driven by the effects of these import taxes. With the economy slowing down, household incomes will fall, and people will have less to spend. That means families won't be able to afford those extra presents or other holiday staples like food, decorations, and travel. Increased living costs will create a ripple effect, making it harder for families to balance their budgets, especially in lower-income households. When the cost of living increases, it forces people to cut back on spending. Increased tariffs on toys and everyday goods aren't just a small issue. They're contributing to a larger financial strain on families, particularly during a season when they should be focused on joy, not stress. This Christmas, expect higher prices on gifts like Barbie dolls and Lego sets, rising by 10 to 20%. A $30 Barbie doll could now cost $33 or $36. Families will face tough choices. Do I buy the toys my kids want, or cut back to stay within budget? Many will struggle with this decision. These price hikes won't just affect toys. Families might skip holiday treats or travel plans because they can't afford it. What does this mean for the holiday spirit? It's hard to feel festive when your wallet is tight. Critics, including Senator Elizabeth Warren, argue that Trump's tariffs harm consumer confidence and destabilize the U.S. economy. Families will cut back on spending as economic uncertainty and inflation make it harder to enjoy the holidays. Instead of celebrating, they'll worry about essentials. 71% of Americans believe tariffs are driving up prices. And right now, Japan, a strategic ally of the US, is suddenly pivoting away from Washington. Why would such a close partner turn its back just when America needs support the most? Japan's pivot, choosing China over the US. Every year, Japan trades with China on a massive scale. Nearly 20% of Tokyo's total exports flow into the Chinese market, making Beijing Japan's top trading partner. If Japan agrees to join a US-led trade bloc aimed at countering China, it would be tightening a noose around its own economy. And Tokyo has made its position clear. It cannot sacrifice national economic interests to serve an unclear geopolitical strategy. Even before the US officially made a request, Japan proactively announced it would refuse any proposal to restrict trade with China. This marked a major shift in foreign policy, and it's just the tip of the iceberg. Strong criticism. Japan speaks out like never before. Japanese diplomacy is usually discreet and cautious, but this time, officials have gone public. A senior negotiator likened the US demands to a form of extortion. He stated bluntly,
大臣、そのやんちゃぶりをぜひ、アメリカとの交渉においては、発揮をして、いただく、カツアゲには屈しないということを、ぜひ、お約束。
This wasn't just criticism, It was a direct rejection of what Tokyo sees as a non-transparent negotiation model used by the US. Japanese officials argue the US constantly changes its negotiation goals, lacks coherent arguments, and fails to provide any reasonable formula for the proposed tariffs. Out-of-control tariffs. When the math is wrong. Here's one example. The US president claimed Indonesia was imposing tariffs of up to 64% on America. Where did that number come from? They took the trade deficit and divided it by the total value of Indonesian exports to the US. But that's not how tariffs are calculated. The correct formula is to divide the total customs duties collected by the total value of imported goods. And that's why a Japanese official had to speak out.
あの数式だってめちゃくちゃですよ。私も数学得意じゃなかったけど。
Backfire effect. Instead of pressuring China, high tariffs are making American businesses pay dearly. Raw materials from China, steel, electronic parts, industrial plastics, are still being bought worldwide at market prices. But US factories must pay up to 145% more, thanks to tariffs imposed by their own government. The result? Soaring costs, shrinking profits, and more manufacturing jobs moving overseas. The Manufacturing Index from the Federal Reserve Bank of Philadelphia, a key measure of industrial health, plunged from plus 12.5 to minus 26.4 in just 1 month. Domestic impact. When Americans speak out. It's not just Japan pushing back. Ordinary Americans are feeling the impact too. According to a recent survey, 64% of Americans do not support tariffs, 71% believe they're fueling inflation, 72%. Fear a recession is coming. A global deadlock. When allies no longer agree. When a loyal US-friendly country like Japan steps away, how many allies are truly willing to follow America down this tariff path? In a world deeply dependent on Chinese raw materials, components, and supply chains, cutting off trade isn't just difficult, it's economically unfeasible. Tesla just lost 71% of its profits in a single quarter. Its stock has plunged 41% in under 4 months, and now there are rumors that Elon Musk may be replaced. Tesla reported just $409 million in net income for Q1 2025, down from $1.39 billion the same time last year. That's a jaw-dropping 71% collapse. Revenue hit $19.34 billion, below Wall Street's forecast of $21.11 billion, and down 9% year over year. This isn't a glitch, it's a direction. Despite a small 3% bounce in after-hours trading, Tesla stock is still down over 41% since January. That's hundreds of billions in market cap just vanished. And then came the rumor. The Tesla board is allegedly contacting executive search firms, setting the stage for a new CEO. Chairwoman Robin Denholm denied the story on X, saying the board has full confidence in Musk. But investors aren't just watching earnings, they're watching momentum disappear. Global EV competition is heating up, and Tesla no longer looks untouchable. Wall Street is asking, is Musk still the driver, or just along for the ride? But here's the twist. Elon Musk is now more than a CEO. He's a political lightning rod. Wearing a MAGA hat during a recent cabinet-style meeting sparked backlash from investors. For public companies, politics is bad for business, and shareholders know it. According to Reuters, Musk spends about 40% of his time on ventures outside Tesla, SpaceX, xAI, and even Doge-related orgs. That split focus is hurting Tesla. A Morning Consult survey shows that 32% of Americans refuse to buy a Tesla because of Musk himself. In China, Tesla sales fell 22% in Q1. In Germany, a staggering 62% drop, fueled by protests over Musk's controversial statements. Institutional investors are starting to voice concerns, saying Musk's personal brand is becoming a corporate liability. Some funds have quietly reduced their Tesla exposure. Others are pushing for governance reform inside the boardroom. The message is clear. One man's ego shouldn't steer a trillion-dollar company. Q1 sales just 336,681 vehicles. That's a 13% drop compared to 2024. Tesla is no longer the world's top EV maker. That crown now belongs to BYD. In California, Tesla's home turf, market share dropped from 56% to just 44%. It's the first time in nearly a decade that Tesla lost the lead, right in its backyard. Two key execs left the company in late 2024, Drew Baglino, Senior VP of Powertrain, and Rohan Patel, Vice President of Public Policy. Their exits leave a gap in both strategy and public outreach. Major firms like JP Morgan and Barclays have slashed Tesla's stock price targets and warned, without change, growth will reverse. Tesla isn't just a car maker. It's the center of an entire tech ecosystem. Partners like Panasonic, CATL, and NVIDIA are deeply tied to Tesla's supply chains and innovations. When Tesla's market value fell from $1.5 trillion to just $800 billion, it didn't just hit Tesla. It rattled the Nasdaq. It shook major ETFs. It shredded tech portfolios. Tesla once symbolized American innovation, a bold response to BYD, Hyundai, and Volkswagen. But now, with Musk juggling roles, declining sales, and fading public trust, one question remains. Will Tesla survive the storm? Or are we witnessing the slow-motion fall of an empire? The $43 billion aircraft order could be cancelled, and the impact doesn't stop at Ryanair or Boeing. It leads to higher ticket prices, more expensive goods, and harder to get electric cars, all the burdens falling squarely on U.S. consumers. Price increases. Who's paying the price? The 25% tariffs on imports from China are creating a widespread wave of price hikes in everyday American life. A TV is now $200 more. A box of butter has gone up by $2. Clothing, shoes, electronics, and essential consumer products all are rising by 5% to 20%. Inflation in 2025 has hit 4%, pushing average monthly living costs up by $150. For high-income households, this might not seem significant. But for low-income families, that's a week's worth of groceries or half a month's travel expenses. The impact of tariffs doesn't stop at the supermarket. It's spreading across the supply chain, forcing businesses to raise prices to cover import costs. And in the end, the ones bearing the brunt are the consumers. Americans are paying more for the same lifestyle, with fewer choices available. Airline crisis. The $43 billion threat. Ryanair, Europe's largest airline, has warned it will cancel an order for 210 Boeing aircraft worth $43.2 billion if the U.S. imposes tariffs on the aviation industry. Aircraft prices will rise, pushing operating costs higher, which will increase ticket prices by 5% to 10%. Ryanair's low-cost model is under threat. Cheap tickets will disappear, flight frequencies will decrease, and many international routes may be delayed or cut. To ease cost pressures, Ryanair is considering switching to Chinese-made aircraft, which are 20% cheaper, but they are not yet certified for operation in Europe, posing significant risks. This issue isn't limited to Ryanair alone. Xiamen Airlines from China has returned at least 3 737 MAX 8 planes due to U.S. tariffs, causing many international flights to be delayed, making it harder for passengers to plan and increasing flight costs. Ryanair, Xiamen, and even Air India are all putting significant pressure on Boeing. And throughout this entire crisis, consumers are the first to bear the consequences. Declining sales and rising car prices. Tesla losing ground. In April 2025, Tesla's electric vehicle sales in Europe plummeted, down 60% in France and 67% in Denmark. This situation has impacted global supply, driving up car prices and limiting options. Consumers now have to accept higher prices or turn to competitors like Volkswagen, Nissan, or BYD. But these alternatives are not cheaper, and service remains inconsistent. At the same time, Tesla showrooms in Europe are facing continuous protests and vandalism. The company is being forced to scale back operations, reducing the number of models available, making it harder for consumers to find electric cars that meet their needs and budgets. Shopping woes when consumers lose their choices. Air India has temporarily suspended new orders from Boeing due to uncertainty over delivery schedules. The fleet modernization is delayed, directly affecting the plans to operate international flight routes. Passengers now face the possibility of flight delays or being forced to switch to other airlines with available fleets. In Europe, if Ryanair cancels its Boeing orders, the consequences will spread even further. Fewer airplanes mean fewer flights, and cheap tickets, one of Ryanair's hallmarks, will become scarce. Consumers will be forced to pay higher prices for tickets or wait longer to travel. Tesla losing trust. Politics hits consumers. In April 2025, Tesla saw a sharp decline in sales, down 60% in France and 67% in Denmark. Political boycotts, protests, and vandalism have caused consumers to lose trust. Tesla is no longer the top choice. Buyers are turning to brands like Volkswagen or BYD, but prices are high and supply is limited. Trust has collapsed, choices are shrinking. Consumers continue to bear the brunt. A modest 1.7% increase in Costco's same-store sales. Falling short of expectations and almost immediately, its stock dropped nearly 6%. Is this merely an isolated incident, or is it a warning sign for the entire U.S. economy? A retail giant shows signs of strain. Costco, long viewed as a pillar of retail stability in America, recently released its Q2 2025 earnings report, revealing figures that have unsettled investors. While total revenue increased by 4.2% year over year, same-store sales, a key indicator of retail health, grew by only 1.7%, significantly below Wall Street's anticipated 3.5%. Following this announcement, Costco's stock declined by 5.8% in after-hours trading. This development is particularly noteworthy because Costco serves as a bellwether for U.S. consumer behavior. With over 90 million members and 591 domestic locations, the company's performance offers insight into broader spending patterns. Costco's chief financial officer highlighted a significant shift. Consumers across all income levels are becoming extremely cautious. Spending power is diminishing, and these warning signs are emerging even at a retailer renowned for its value offerings, shifting consumer behavior and its implications. The earnings report also noted a 6.8% decline in electronics and high-ticket item sales, suggesting that even upper-middle-class shoppers are reducing non-essential purchases. Conversely, sales of essentials like groceries and household supplies increased by 4.3%. This trend indicates a broader defensive mindset among consumers nationwide. Surveys reveal that 58% of shoppers are buying fewer non-essential items compared to 6 months ago. Despite Costco's affordable $60 membership fee, store traffic decreased by 2.3% year over year, the first such decline in nearly 4 years. This trend has significant implications, as nearly 75% of Costco's operating profit derives from membership fees. A modest 1 to 2% drop in renewal rates could disrupt the company's financial foundation. Wider retail sector under pressure. Costco's challenges are not isolated. Bed Bath & Beyond, once operating over 1,500 stores, now has fewer than 350 and plans to close 45 more nationwide. In Chicago alone, 3 locations were recently shuttered with minimal notice. Similarly, Best Buy announced a reduction of 3,500 retail employees while maintaining its corporate and technical staff. Interestingly, the company's stock rose by 3.2% following the announcement, reflecting investor approval of cost-cutting measures. Gap Inc. has cut 400 corporate positions, and Walgreens intends to close 1,200 stores over the next 3 years. These developments underscore a broader trend. Traditional retail infrastructures are struggling to justify their operational costs amid changing consumer behaviors, declining consumer confidence, and economic ripple effects. In April 2025, U.S. consumer confidence dropped for the 5th consecutive month, with the Conference Board's index falling 7.9 points to 86.0, the lowest since May 2020. The Expectations Index, reflecting consumer short-term outlook, decreased by 12.5 points to 54.4, signaling heightened concerns about future economic conditions. This decline in confidence is driven by persistent inflation, elevated interest rates, and job security concerns. Intel, for instance, announced plans to reduce its workforce by over 20% as part of a restructuring effort. A Morgan Stanley survey indicates that 68% of Americans plan to cut discretionary spending due to economic uncertainty, with this figure exceeding 80% among individuals aged 45 and older. These trends suggest a collective move toward financial caution, potentially leading to reduced consumer spending and broader economic implications.